We've seen the U.S. 10-year Treasury yield spiking towards 4.2% today. Investors are awaiting speeches from Federal Reserve policymakers, including Fed presidents from Dallas, Minneapolis, and Kansas City. Let's get more from Robert Shine. He is Chief Investment Officer at Blanky Shine Wealth Management. Thank you very much indeed for joining us. Could you start off with this move up in bond yields? What do you think is behind it?
Yeah, we're seeing, gold is up, bond yields are up. There's still the question and the concern that inflation is still there. And that means that the Fed still might have some more work to do. But I think, the day after the election, we'll get another Fed rate cut. But as of right now, yields are backing up.
And are people concerned about inflation? Is that the reason?
Yeah, so 87% of the time, historically speaking, in the last 5 inflation bouts, we've seen a resurgence of inflation. So it's not a concern that's out of bounds by any stretch of the imagination. It just takes years to get there. I think we're still on the downward trajectory. If you look at some of the numbers that have come out, the trend is still on the side of inflation coming down. But let's keep in mind, it still had a high number to begin with. So this trend, there's still a lot more work to do on the inflation front, just for every single day of Americans.
We know people are hurting, okay. So your take is that the Fed, after the November 5th election, will cut again?
Yes, we believe we're going to see 25, not 50. But we still think that there's a lot of, pressure that's built up on the consumer, even though the consumer is held in there quite significantly. And we're seeing that play out in corporate earnings as well, that the consumer is solid, but there is a lot of pressure of this long and variable effect, the lag effect of higher interest rates. And so that's playing out for sure.
Looking at the broad market, you think some investors are in cash, but there's a risk they'll overstay their welcome there?
Now's the time. So, historically speaking, cash has always been not at these levels that we've seen. So what that tells us is that the consumer is sort of in that wait and see, suspended animation. Obviously, we've got a lot of geopolitical events going on, but more importantly, less than just about 2 weeks away in the U.S. for the election here. So once we get past the election, we believe that, it's time to basically put cash to work today. I wouldn't wait 2 weeks from today because, again, like I said, the interest rates are going to be dropped in the United States. Lock in term, lock in duration, but cash in the next 12 months would be probably one of underperforming asset class.
We've seen oil. It struggled last week, as you know, fell about 8%. We did see it move briefly above $70 this morning. Right now, it's back above $70. Do you think the market is complacent about the violence, the conflict in the Middle East, and the risk to supply?
Most definitely. And there's a lot more levers that are being pulled, even with the geopolitical disruption over the last 2.5, 3 years that we've seen. Oil markets have taken that in stride. Now, again, fast forward, it's a 50-50 race right now in the United States. If we have, let's say, a Trump presidency, he's going to drill, and that's going to put more pressure or bring down the price of oil. So right now, it's short-term concern of the geopolitical risk that you're seeing. But the oil markets the last 2-3 years, oil should be at $100 a barrel. But it's amazing how it's taken this in stride. So I think that more the pressure is for oil to be coming down in the future, based upon all the levers that could be pulled in the oil markets. But it remains to be seen how this will play out.
You say oil should be $100. You mean in terms of economic fundamentals or supply?
All of the above, even the demand out there and the growth of the economies that we're seeing. We don't have enough energy, whether it's, even traditional versus EV energy. The globe is growing. And so although we can turn on supply, there's a lot more demand out there. So there's that inherent imbalance, if you will, structurally.
What about classic cyclicals like copper, or using copper as an example, or zinc? Would you be interested in base metal miners right now? They would tend to do well, of course, if China recovers, for example.
Yeah, China is big in that space in terms of the story as it relates to sort of do the miners, does copper continue? Copper has always been a gauge of the global economy. But we're seeing, obviously gold, maybe silver pick up a little bit, but gold is the show today. And that's simply just the old fashioned inflation hedge that we're seeing. So, but if we do see, like you stated, if we see China sort of pulling their own weight, the second largest economy in the world, as well as the U.S. maintain, we could see a case for metals as well.
And what you touched on, well, we touched on retail investors and their cash, but also consumers. Do you think the US consumer is a good bet right now? Would you be interested in, say, discretionary apparel companies, for example?
Yeah, absolutely. There's a lot of great discretionary companies that are, consumer-based, consumer-driven, that are still discounted year to date with relative to the S&P 500. So there's a lot of opportunities out there. One of the things I've learned many, many years in this industry is an economist said, don't ever bet against the U.S. consumer. And whether it's a recession, whether it's booming times in the economy, that economist was 100% right. So the consumer is going to find a way. Plus, think about this. If you have rate cuts continue their trajectory on the downside, there's $44 trillion of untapped equity in the U.S. housing market, which again can add more fuel to the fire in addition to the cash on the sidelines for the consumer.